Hello everyone, Kevin Shortell here. Today I'd like to talk with you about the easiest and safest way to invest in passive cash flow, and that is buying short-term income streams. What are short-term income streams? Let's talk about that in just a second. But first of all, think about this. As a passive investor, you do have choices, plenty of choices in the marketplace to invest in. You could invest very passively in the stock market, for example. But what's going on in the stock market right now? Is it going up? Is it going down? Kind of depends upon the day right now, doesn't it? And a lot of investors are shying away from the stock market because they're afraid of losing investment capital. Some people are looking at bonds as an alternative, but the issue with bonds is this: the coupon rate, if you will, the face value of your note goes down when interest rates goes up. And all indicators show that the Fed is going to continue to increase those interest rates. So you have to be careful in the bond market as well. Well, what about cash? What about a wealth preservation strategy? Cash-like investments, although up 2% now for CDs and T-bills, but where are you going to get on 2%? Inflation is more than that. So cash-like investments are safe, but they're not going to work for you. So what about rental property? I don't consider rental property to be a passive investment. It can be, but every investor that I talk to who's a landlord has always told me, no matter if they have property management in place or not, they always feel like they have the day-to-day decisions on property management. And there's always issues that come up with tenants and moving out and problems at the property. So passive investing, not really on the rental property side, in my opinion. What about crowdfunding deals? Well, crowdfunding is an interesting way to invest, where you are contributing money with a lot of other investors, and they're buying buildings and all sorts of things today. But Realty Shares, by the way, if you look up the one of the biggest and earliest companies in the crowdfunding space, is no longer in business. And that's really scared a lot of investors away from those crowdfunding deals, because that simply wasn't expected, and they were one of the biggest ones out there. So be careful on that crowdfunding. What about private lending? I love private lending, used to do private lending. Here's the issue though: when you're taking on new clients, first of all, you have to advertise for those clients, you have to work with those clients, you're taking on additional risk when you're originating a loan. It's still in the paper business, but you are doing origination, and that's going to require that you're more active or have a staff that can handle that for you. When you compare that to buying short-term, 2 to 5 year, I'm talking here, performing income streams, there's nothing like it. It's a fantastic investment. It's safe and it's high yielding. Let me give you an example of that. Let's say you have a property here that's worth $130,000. Now for us, in buying this note, that is our collateral. That's what backs our investment if things go wrong. And perhaps they owe $120,000 on this and they had a 30-year loan. Well, what if this note's already seasoned? What if they've already made 2 years of payments, in other words, and showing a proven track record? Does that enhance the value of the likelihood that they're likely to continue to pay? Yes, it does. So they've got a little track record behind him here of 2 years of making these payments successfully. So you come in, you're not going to come in and buy all 28 remaining years worth of payments. You're just going to come in and buy the next 60 payments, the next 5 years of payments. So that gives you a short-term but high-yielding and very safe investment. Why very safe? Well, think about it this way. You're in this deal for about $42,400 for the next 60 months. That's going to generate for you $880 per month. By the way, that is a 9% annualized return. But what's it backed by? It's backed by a property that's worth 3 times what you have in that deal. So if things go wrong, you're in a very, very safe position, because you are the most senior lien holder on this note. And by the way, what about the other investor that you bought the note from? Well, after you collect your 60 payments, they would start collecting the payments once again. So they have a vested interest to make sure that this deal goes well for you. And that's an additional safety mechanism. Now, by the way, after you buy the 60 payments and you receive your 60th payment, could you buy another 5 years of payments? Of course, you could do that as well. So buying 2 to 5 year performing income streams does provide for you everything that investors today are looking for: safety and high returning assets. The good thing is it can be done from any place. You simply have to have access to the internet to communicate with your seller, to do some additional research on the property. Analysis can be done in 20 minutes. Now, once you're trained, it probably won't take you 20 minutes your first time, but once you're trained properly, Remember, these are performing notes, not non-performing notes. Non-performing notes take a lot more due diligence, and I would consider that more of an active technique. This is very, very passive. You're going to go through several websites to verify valuation. You're going to look at some documentation to see if there's any other claims or liens on the property. All of that, once trained, can take you as little as 20 minutes on these types of notes. Anything above and beyond that, if I need help getting a valuation, because I don't know, maybe it's a rural property or something like that, and there's not a whole lot of comparable sales, I can always outsource that to a third party. I can have a real estate agent go out and do a BPO for me, or if I need help on title, I can have a title company run title for me and explain that information to me. So we do have third-party vendors available for additional research should you need it. And again, depending upon how educated you are in the business, you don't have to travel anywhere. You don't have to travel to see the property, and you're certainly not going to attend a closing. Why? Because the paperwork is very, very simple. It's a one-page, two-page form that needs to be signed, and as I'll talk about in just a second, you don't even have to sign anything. I'll come back to that in a moment. The big benefit for you here is this. These loans already have third-party servicing in place. Now, again, I'm assuming you're using a good vendor here. They already have third-party servicing in place. In other words, they're collecting these payments already. They're making sure taxes and insurance are paid. And all they'll do, just keep it with the same servicing company, is now switch the payments over to your bank account instead of the investor that sold these to you. So the components involved in this, understand a quick analysis. You have to be able to run through some numbers here. The numbers have to make sense. The story has to make sense, but all the documentation is fully available. Payment histories and everything else will be provided to you. Outsource the skills that you don't have, or outsource the necessity, the research that you're not able to do. In other words, BPOs, title reports, anything like that that you would need help with, very easy to have other people do that. Use a trusted source. Now, if you're working with me, of course, you'll get those trusted sources, but if you're blazing your own path on this, please do your due diligence when you're looking at people selling notes. They should provide you with full documentation without hesitation. After all, a lot of that documentation is already a part of public records. You want to see the sample of what their deals look like. You want to perhaps even get some referrals from other people so you can truly check out that source. And finally, the paperwork. Once again, on the paperwork in this business, on your due diligence, you've got to go through some title reports, and that's pretty easy if you know the key things to look for. I don't spend hours reading every single word on there. I go to 3 or 4 key points that I'm looking at on there to make sure that my investment is safe. And then when it comes to closing, you don't have to be at the closing. There's nothing for you to sign. In this industry, the note seller signs the note and signs the collateral agreement, the mortgage, over to you. So the closings are done very, very quickly. An assignment of the mortgage is typically 1, maybe 2 pages, and the endorsement of the note is a 1-page document. And your servicing company can collect those, store those, record the contract that's necessary, the mortgage, if you will, and those are really the 4 main components. So this can be the easiest way to get into the note business. It does have a very, very low risk because you're only coming in for a small amount of money versus what the collateral's worth. The person or company that you bought the note from does have a vested interest in that deal going well also, and you're making high yields. Where else could you go to get 8 to, let's say, 12% returns with the security of knowing that if things go wrong, it's backed by something 2, 3, or more times what you have in the deal? So hope you enjoyed this video blog. Come see me at live events, or shoot me an email if you'd like to get started on this at kshortle@icloud.com. That's kshortle@icloud.com.